Hello, and welcome back to Explain the Charts, your go-to channel for no-nonsense technical analysis. Today is October 23rd, 2025, and we're breaking down the SPY S&P 500 ETF, ticker symbol SPY. The market is at a fascinating crossroads right now, taking a breather after an incredible run. Headlines are filled with uncertainty, creating a cautious atmosphere among investors. We're hearing reports of a potential escalation in the US-China trade war, which caused the Dow to drop over 300 points yesterday. This sentiment was amplified by lackluster earnings reports from key players like Tesla and IBM, which seems to have dampened investors' risk appetite. Netflix also took a significant hit after missing earnings, while crude oil prices have jumped, adding another layer of complexity. Looking at the daily chart, we can see this news reflected in the recent price action. After a powerful multi-month rally that started back in April, the momentum has clearly stalled out over the last couple of weeks. We've been pushing up against a major resistance level, forming what looks like a potential top. Let's zoom in on the price action just for October to get a clearer picture of this battle. As you can see, the price pushed up and was rejected sharply at the 673 level on October 10th. That day saw a massive red candle with high volume, taking the price from a high of 673.95 all the way down to a close of 653.02. This 653 level immediately established itself as a very strong short-term support zone. The market then spent the next week grinding its way back up to retest that 673 resistance area. On October 20th, we touched 672.21, and yesterday, October 22nd, we opened right at 672 before getting slammed down again. This price action has formed a classic double top pattern, which is often a bearish reversal signal. Yesterday's candle is particularly telling. It's a large red candle that opened high and closed near its lows, showing that sellers were firmly in control throughout the session. The low of that candle, around 663.30, now acts as our most immediate, minor support level to watch. Now let's switch to the 15-minute chart to dissect yesterday's trading session. This gives us a granular view of how the news impacted intraday sentiment. We can see the price was already weakening in the pre-market and early session. The significant selling pressure began around 1400 hours Universal Time Coordinated, where the price broke down decisively. Through the mid-afternoon, there was a steep decline from the 669 level down to the session low of 663.30. Volume was elevated during this sell-off, confirming the bearish conviction. However, in the last couple of hours of the trading day, we saw a bit of a battle. Bulls defended that 663 level, and the price managed to bounce back and consolidate, closing the day around 667. This indicates that while sellers dominated the day, there is some buying interest at these lower levels. The fight into the close suggests indecision heading into today's session. To understand the significance of that first major rejection, let's briefly look at the hourly chart from earlier in the month. Here on October 10th, we can see the anatomy of that initial, aggressive sell-off. The price action was brutal, with consecutive large red hourly candles taking the market down over 20 points in just a few hours. The volume on these down moves was immense, signaling that institutional players were likely taking profits off the table. This was a clear character change for the market, shifting from a steady grind up to a swift and volatile drop. That event established the high-volume resistance and support levels that are defining our current trading range. So, let's go back to the daily chart and put it all together for a final summary. The long-term trend remains bullish, but the short-term picture is decidedly bearish to neutral. We are currently consolidating between a major resistance and a major support level. The key price levels to watch are crystal clear. Our ceiling and the most critical resistance is the double top area around 673. Our primary support level is the October 10th low around 653. A more immediate, minor support level is yesterday's low of 663. So, what are the likely scenarios from here? Given the double rejection at a key resistance level combined with negative news catalysts, The bearish scenario seems slightly more probable in the short term, perhaps a 60% chance. In this case, a break below 663 would likely lead to a retest of the major support at 653. A failure to hold 653 would signal a deeper correction, with the next logical target being the 640 to 645 area from the August consolidation. This scenario would be reinforced by more negative trade headlines or poor earnings from other major companies. Conversely, the bullish scenario has about a 40% chance of playing out. For the bulls to regain control, they need to push the price back above 673 and hold it. A strong, high-volume breakout above that level would invalidate the double top and signal a continuation of the primary uptrend. This would likely require some positive news, such as an easing of trade tensions or a blowout earnings report from another tech giant. Until one of these key levels is broken, we could see the price chop sideways between 663 and 673. Therefore, the things to look for are a decisive break of these identified levels on significant volume. Pay close attention to the news cycle, as it is clearly influencing market sentiment right now. Thank you for watching this analysis on Explain the Charts. Please remember, this is not financial advice and is for educational purposes only. Always conduct your own research and due diligence before making any investment decisions. If you found this video helpful, please hit the like button, subscribe to the channel, and we'll see you in the next one.